David, thank you so much for joining us today. Really excited to have this conversation. Seems like it's really resonated with our audience, and a lot of folks are interested to learn more about you all. So, for those who don't know you, tell us a little bit about yourself, your background, and what exactly is OpenVC.
I'll keep it very brief on me. Pretty straightforward. Went to liberal arts college at Amherst in Western Mass. If anybody's NESCAC here, feel free to throw a shout at the end. Started my career in Goldman in their TMT coverage practice, and then moved to Houston, where I joked that I was hired to de-gilt a family business that was almost exclusively O&G, and I was hired to focus exclusively on tech and anything green enabled. So did that for a few years before founding Open. Open is backed by the New York Stock Exchange's parent company, ICE, and we do two principal things. First, we create private market indices. So imagine the S&P 500 for unicorns. And second, we create ways to engage with those indices, namely funds, fund products, or derivative structures that enable investors who have traditionally been locked out of private assets, in particular venture, to access them in a way most familiar to a typical retail investor, which is investing in an index fund. So aspirationally, you could think of us as kind of like a combo business, one half being almost an S&P data style business, and the second, hopefully, being like a Vanguard or a BlackRock for private markets.
Well, we're big believers in kind of the index approach and having exposure to these alternative asset classes, obviously a king's crowd. And I think you guys are taking a really unique approach, focusing on kind of the late stage secondary market. Let's talk a little bit about kind of some of the bigger players that are starting to realize that indexing the private markets is the next frontier. I know there's been a major acquisition recently kind of in this data space, but talk to me about what you're kind of seeing in the market around the indexing approach of private markets.
You're spot on, Chris. I'm pretty sure you're referring to the BlackRock Preqin acquisition, but BlackRock, for those unfamiliar, just bought Preqin for about $3 billion. And the principal rationale of the acquisition was they want to apply the BlackRock approach, which is low fees, high diversification, really just kind of hawking index funds to private markets. And they need the data to do that robustly, and purchasing Preqin was a big piece of that. Larry Fink, BlackRock's CEO, actually came out and said they want to index the private markets. And when you step back and kind of look at why they're making that acquisition now and why we think this is a great time to kind of tap into that next frontier, you realize two critical things. One, the data in private markets is finally robust enough to allow someone like a BlackRock to enter the space in a way that they can robustly deliver a product that their customers are used to engaging with. And two, there is enough kind of volume and liquidity in private markets for some of the largest names that people candidly haven't been able to access but have tremendous interest in. Think OpenAI, SpaceX, xAI, Stripe, etc., to actually create real markets for an institutional investor. So it's come at a great time. We're hoping to capitalize on that trend by introducing really the first institutional grade index that a BlackRock or a Vanguard or somebody could create a product against.
Now, when you see all of this kind of interest from the institutional level saying, hey, we want to index private markets, we want to create liquidity within the private markets, especially kind of that later stage area. Traditional venture capital has always been, hey, we're the only access point. We're the best at what we do, even though we'll tell you we fail 90% of the time. So when you think about what the implications are of indexing and what happens to the overall venture industry because of that, what are some of your thoughts on and perspectives on what will happen to kind of traditional venture as this model becomes more mainstream?
Yeah, it's a fantastic question. I look to earlier asset classes and examples where this has already happened as a guide. And candidly, index investing, people think it's been around forever. It's actually relatively novel. It was pretty much invented by Vanguard with mutual fund indices in the late 70s, but didn't take off in a major way until BlackRock and others really started pushing it. And what you saw is basically a collapse of extraneous outcomes and a reversion to the mean. So whereas in public markets, everybody used to charge high fees, you had a single asset picker, and your retirement advisor was basically, your active fund manager, the middle of that market that couldn't now keep up with cheap indexing fees disappeared. And we would anticipate something pretty similar happening in private markets, particularly venture, ultimately to the benefit of the consumer, right? Now, I want to caveat, that's not to say that venture capitalists don't do a great job. Like, we want to work with venture capitalists. We think that there's absolutely a space for, kind of the top quartile of VC managers who have great relationships with the companies, are really out there, rolling up their sleeves, doing the work of identification. But for the average consumer, that's simply too expensive and too risky a proposition to engage with on a day-to-day basis. And so they entirely miss out on all of that market's offering with respect to, the next generation of innovative companies, folks who are staying private much longer that they can't participate in, whereas, they might have been able to in the past. And even if it were cheap, just frankly not being legally allowed to invest in a venture fund as a non-accredited user. So eliminating that middle, so to speak, is what indexing will very likely accomplish.
So now to kind of, that's, hey, long-term thinking, right? How we see the space evolve. But if we look at the short term, there's obviously been a ton of volatility both in the public markets and the private markets. I think something just came out from PitchBook saying 30 to 40% of venture rounds right now, or flat or down rounds, right? Which is kind of unprecedented over the last 15 years or so. What opportunity is that creating for Open VC that's kind of focused on those late stage secondaries? Is now a good buying time? What's some of the behavior you're seeing out there?
So now is a good buying time. The best buying time would have been kind of at the, a nadir of the recent low, which was, I believe, like kind of mid 22, late 23, although a lot of that is tied to SVB. And frankly, the overarching message that I pitch with indexing is keep it boring, try not to time the market, right? That said, the market is pretty depressed, right? There are certain outliers, AI doing extremely well. Stripe is back to kind of where they were pre that primary round that cut their valuation in half. SpaceX is a consistent outperformer. But apart from a handful of names, folks are really reacting to a tighter capital cycle, venture capitalists really emphasizing profitability. And if they don't need to raise, they're not, which is forcing folks who are holding assets either long in the tooth, venture capital funds, or even employees of those companies, to not have any liquidity options. And that's keeping prices down for many of these companies. So if you were to look at the secondary market in isolation today, there's certainly a significant buying opportunity, I'd say, outside of AI and kind of those super marquee companies, which have pretty much recovered.
When you look at some of the kind of discounting in the market, again, outside of the outliers being AI and someone like Stripe, what are you seeing on average? Is it 20, 30% depressions from high levels, or what does that kind of look like?
A little more, actually. And it depends on what you're looking at, right? If you're looking at year to date, stuff is actually flat or even a little up. If you're looking at last primary round, where many of these companies that are still in business haven't raised a primary round since 21 at the absolute apex of valuations, because they don't want to have a down round on the books. And if they're profitable, oftentimes they don't need to take that. They're trading, 45, 50% down. So if you're operating on the thesis that these companies are very likely going to IPO, but they're not going to IPO at a valuation materially depressed, maybe slightly depressed, but not materially depressed from that last primary round, then there is a delta between where you can pick up these assets today, again, in the kind of 45 to 50% discount range, and where the eventual IPO price will land.
That's really interesting. Certainly creates a lot of upside for investors. Let's talk about some of the big names that you see out there that you're interested in looking at, that you think are presenting good buying opportunities. And maybe you can't say that specifically, but some of the big names that are out there in kind of the late stage secondary space right now that are actively trading and providing an opportunity to get into.
Yeah, there are a few that are kind of really experiencing material discounts from their last primary round that I would highlight. probably off the top of my head, Anduril, Epic Games, and Rippling are pretty good buying opportunities. Anduril actually might be back closer to par right now because of recent developments in global security, and we'll just leave it at that. But there are there's a lot of interest in Epic in particular, just given their Unreal news, and also their valuation effectively collapsed in the wake of 21 and 2022 underperformance as it relates to some of their marquee offerings, and I think it collapsed prematurely. So I would definitely look at that. I'd say writ large, just taking a step back though, and maybe thinking about sector. AI, it's super hot, right? But in the public markets, which often kind of forerun the private markets, you're already seeing chip manufacturers kind of start to plateau. I would expect some of that phenomena to leak back into private markets, and there may be buying opportunities in the next quarter or so where maybe getting that 45-50% discount, but there are certain AI companies that, for example, would be in our index, like Scale, et cetera, where you can get at par or a little bit of a discount because they're reacting to that leveling in the public markets.
One thing I'd really like to dive in on, and I think a lot of our listeners would be interested to hear more about. So you're developing this index. Where are you getting this data on these secondary transactions? And how are you building an index, that is fluid in the private market, something that's really never existed before?
Yeah, that's kind of the question, to be honest. So there are people who have tried this, right? But full disclosure, like if you, Chris, want to make a private markets index, you can, right? There's nothing stopping you from saying like, hey, I think Stripe is worth, wherever the wind is blowing today, and I'm going to do that for 49 other companies and publish my results on a daily basis. The problem is there is no what we would call institutional grade. And what I mean by that is regulatorily compliant index out there that meets the critical data standards for someone like a BlackRock or a Vanguard or a State Street to come and say, hey, I want to license that index to develop product for my consumers, or institutional investors who say to us as an asset manager on the other side of things, hey, I want to invest in your fund because it's institutional grade, right? If you don't have that institutional hallmark for your index, if you don't meet the regulatory burden of the data quality, it's pretty much impossible to scale. So our challenge has been meeting that regulatory burden. And to your point, all of that has really been around the quality of the data we've been able to source. So we're somewhat unique insofar as, our basically parent sponsor is the New York Stock Exchange, which gives us some leeway in terms of branding. You'll hopefully see next week, but our index with the New York Stock Exchange is actually launching. The New York Stock Exchange Open Unicorn Venture Capital Index. That's big in terms of people wanting to give us their data. And second, I think more critically, a lot of this secondary market data is created by buyers and sellers, really brokers, of which we are not, right? And so that critical competitive positioning, us deciding, hey, we are not going to be a broker. We're not going to compete with the people who are actually creating this data for us, has opened the door to be able to collect data from parties who really don't like to talk to each other, and consequently give us the deepest breadth of data in the secondary market available. So that meets that regulatory burden. When you combine that with the ICE branding, kind of the NYSE hallmark of a sponsored index, you unlock what we believe will be that really institutional channel. And that makes us hopefully the only kind of veritable index in town.
Now, one of the things that makes an index powerful is when you have enough volume of transactions, right, where the lines start to be fluid, right? One of the things we've tried before at Kingscrowd is to kind of index the early stage markets, but the primary offerings are only happening every 15 to 24 months. It's a pretty static, index where you're just waiting for companies to fall out or do a new round of funding. And so it ends up looking real wonky. So creating that fluidity in the line where you go, okay, there's a real index here. That's a challenge. When you look at volumes from all these different sources, Can you give us a sense of maybe top 50 or 100 names at the level of volume of transactions and data points you're getting on each one of those on maybe a daily or weekly basis?
Yeah, so SpaceX, this just first half this year is almost at 100 million in volume alone.
Wow.
And so we're looking at around 700 million in pure direct secondary volume for the first half of this year in the top names. According to PJT, the anticipated projected total value of the secondary market, which includes SPVs and other layering devices, but given those are so common, we'll include the number here, is something like 200 billion forecast for 2024. So it's actually quite a robust market. Where volume matters is how we filter our index, right? So we are not going to take a company into our index that doesn't have the requisite volume, either not literal volume in terms of like the trade is, over 5-6 million bucks, and thereby, of institutional quality, or just, bids and asks being of sufficient number that you could actually create a market and chart a line, in our index. We would not include someone who doesn't meet our pretty strict liquidity standards. And that goes back to, again, kind of our mantra, which is introduce something that everybody understands, right? To your point, like creating a private markets index, no one's going to understand that if you just use private markets, because invariably, if you want to get rid of the jumps, you're going to have to introduce some subjectivity, right? I'll peg it to a public market index, or maybe I'll peg it to other private comps that are more liquid. Once you go down that rabbit hole, you go into, the realm of more art than science. And that is I don't want to say a negative, but it's certainly less preferable for people who just want something that looks like the S&P.
How many names are you keeping within your index? And just to get a sense of the type of company that's in there, is there kind of a valuation threshold where you start to see a certain level of liquidity where you go, okay, we can add this to the indice?
So we track 1,300 companies, pretty much everybody who's raised a primary round over $1 billion. Of that, we send to our index administrator roughly 300, and those are the ones that we've deemed quality enough to potentially be included in the index. And then the index is the top 50, and that's just by market cap. So where you see that market cap kind of threshold for number 50 obviously varies. SpaceX is rocking at 180 billion right now ish at number one. Could definitely be a member of the S&P if they were public. Number 50 right now is around the $4.5-5 billion range. So around there, you're going to be confident that there's enough kind of robust volume, again, whether it's bid and ask, number of quotations, or actual volume in trade, that the data is robust.
So there's the underlying data, and there's an opportunity to be able to utilize the underlying data product, the data indice. And then there's the actual kind of index fund that's launching next week. I'd love to understand a little bit more of the mechanics around the index fund. Are you just automatically deploying, the same level of dollars into each one of those top 50? Is there a level of due diligence conducted in that, other than just the market cap? Help us understand that a little bit better.
Yeah, so the index is the thing you'll be able to track next week. If you got a Bloomberg terminal or you're bored on Yahoo Finance or something like that. The index fund for now will remain a private vehicle, but it will operate in pretty much exactly the same manner as an aspirationally public index fund would. And so the index is cap weighted, the fund is cap weighted, which means, we're not really making explicit decisions around which company is better, which company, needs to be rebalanced, which we might have to make if it were an equal weight index. So consequently, just as Apple is a very significant portion of the NASDAQ 100, OpenAI is a very significant portion of the Unicorn 50. In terms of where we buy, we seek to focus at the top of the index, and we seek to focus on best executable price. And what we mean by that is we're really trying to arbitrage the fact that we can come in as an institutional buyer on behalf of a less institutional client of the index. So that means going direct where we can. That means buying from trusted counterparties as opposed to on, brokerage sites where possible. All that shakes out to, us being a bit of a price taker, but ultimately in the long run, it shakes out because we're not paying SPV fees. We're not, waiting 6.5, 7 months for a single transaction to close. And that is, or those are some of the pitfalls that an individual buyer may be encumbered by. And then finally, the fund eventually are going to truly turn it into a public index fund and either list it as a closed-end vehicle or convert it to some sort of interval structure, enabling much enhanced liquidity for our users than a typical venture fund.
When we look at, there was a recent name that went public. There's an organization called DXYZ. If you follow the space at all, you may have seen it. And they kind of had an outrageously large run up, and then they've had a pretty large cliff falling off. It obviously, if you looked at the net asset value, none of it really made sense when it was taking off. So for a lot of investors, right, who got in at the wrong moment, they're certainly suffering now. Where do you don't have to speak specifically about a competitor and put them down or anything like that, but help us understand what you think went wrong there, why that happened, and how you're trying to manage how your index is built to prevent things like that from happening.
Yeah. Well, I'll tell you what went right first, which is that DXYZ, to their credit, proved that there is enormous demand for these assets. So, when you have a fund trading at a 2,000% premium to NAV because it purports to have, Stripe and SpaceX and all these really marquee assets in the fund, I think ultimately that's a good sign because it tells the institutional guys, hey, if you can do this with some tact, you can do this, in a risk appropriate manner, there is a real market here to tap into. Where they could have gone a little differently, I think education is so important. And this is why we're starting ours as a private fund and why we're really constraining the construction of the fund to most closely mirror an actual index fund. If you have a consumer who doesn't understand like the difference between Spider 500 and a closed-end fund, you're going to run into situations like this. It's very similar actually to folks who were buying SPAC shares of SPACs, not de-SPACs, after the SPAC buys something, but the actual SPAC just on the basis of it being a Chamath SPAC or a Bill Ackman SPAC or whatever, and bidding up the shares 20, 30, 50, sometimes $70, I think the IPO got to or something, which is basically telling the SPAC sponsor, hey, I'm giving you a 700% premium because this is closing at $10 a share when it goes and buys the company, right? And people just didn't understand like what they were actually purchasing. I think there was some element of that with DXYZ. And where we aim to combat it is frankly education and just making sure that the levers and the mechanism of construction are really airtight.
When within that kind of top 50 names, obviously we know, SpaceX, right? Elon Musk has made it very apparent that he prefers never to have to take that company public based on his experience with Tesla and others. But in looking across that portfolio, is the way that exits are going to be provided or liquidity is going to be provided within that index going to be IPOs that play out over the next 3-4 years for that level of company? Or is it going to be through additional secondary sales of the positions you're getting into?
Our hope is it will be IPOs. You could think of it almost as a pre-IPO vehicle in some respects. And I think that while companies are staying private longer and longer, there is still ultimately a pressure to IPO. You saw it with Klaviyo, you saw it with Reddit. And that's because their investors want it and their employees want it, right? There is an entire contingent of tech employees out there, living like me, I should add, in the one bedroom or studio still, when on paper, that person in California should be able to buy like the whole apartment building, right? People are sick of that. So there's tremendous pressure to get them a liquidity event. And again, if you've raised, a Series H, sometimes it doesn't make sense to keep going in the private markets. And so we do anticipate there'll be significant IPO activity when public markets recover. That's the principal liquidity event for the fund. And what's nice about if the fund actually converts to a listed business development company, which is one of the avenues we're exploring, we can pass back the gains from those IPOs to the investors as a tax advantage dividend. So just like you're buying a REIT, you buy the Unicorn Index Fund and SpaceX IPOs, or even IPOs just a portion of itself via Starlink or something like that, we can pass back that cash gain as a tax advantage dividend. There will be some trading on the secondary, particularly if companies fall out of the index or new ones come in, which happens in theory once a year, could happen more frequently if something kind of outside the norm occurs in the index. But in those instances, you would see us execute on the same markets that, frankly, we purchased those assets on.
Something else I've seen in this market, and this is just to kind of educate our investors, when looking to purchase secondaries, I've definitely seen an issue, especially in companies like SpaceX, where everyone wants in and there's a frenzy for it, that people are getting like shadow shares and all of these instruments where, you know, the idea that you actually get your money back might be in question. Talk to us a little bit about some of the pitfalls you can experience going it yourself, to look out for. And then again, you know, I think you guys kind of end up with what you actually need in terms of shares, right? Talk about the security you get with that.
Yeah, this is so important. If I were to give the listeners one piece of advice, if they're thinking about doing it themselves, it's governance, governance, governance. Governance matters. The structure you are purchasing these assets in matters. And if you are not buying direct, which means from somebody who's on the cap table, meaning you will then be on the cap table, it can become very complicated very quickly. Common things we'll see are SPVs of SPVs. So you have a newly spun up special purpose vehicle buying shares of a different special purpose vehicle with different fees, different requirements. That can become very expensive very quickly. Usually SPVs are a little bit more solid, robust. Like, you know, they're filing their required Form D with the SEC. So they can be paper traceable, but there's definitely work to be done to make sure you're not getting overburdened by fees. Continuing down kind of like the pitfall train, you're going to want to avoid forward contracts in many cases. These are where, you know, a employee or asset holder of any kind doesn't want to run afoul of the company on the cap table in many instances, doesn't think that their share transfer will be approved, and so agrees to sell you the shares at a price that they receive today, right, in the future. Problem with that is if the company doesn't allow it, and then in the future you've got, you know, employee X who sold shares of some company at $10 to you that's just IPO'd at $80, are they going to honor that contract? And they already have the cash, right? So there's a ton of moral hazard therein. So again, just kind of repeating my advice, make sure where you can buy direct. For most people, that's impossible, quite candidly, because you need to be spending really big dollars. And if it's not possible for you, then look for someone like us, right, who can, again, arbitrage that either direct exposure or low fee SPV exposure for you as an institutional purchaser.
In terms of fee structure, let's talk about your fee structure on the index. And then also, do you have any pricing that you can share with us on kind of the data index?
So in terms of the index fund, we charge 2 and zip. So 0% performance fee, 2% management fee. Our goal will be, not to shoot myself in the foot, thankfully the chief revenue officer isn't on the call, but my goal is to drive fee compression in the space long term. So hopefully, you know, with AUM and when we actually list the thing, will come some fee compression on the management fee there. And that's really just to emulate index funds, right? If people are buying, you know, like Spider Growth or Spider Russell 2000 or something of that nature, they're used to paying 30 basis points, maybe 50 basis points in a really expensive public index. The closest thing they should get in privates shouldn't be that different, consequently. And so we've tried to throw away some of the really egregious performance associated fees with venture. In terms of the data product, it really depends. And I know, you know, we've talked about potentially doing something for King's Crowd users. We have an option, kind of a light version, for $2,500 where you can see the companies in the index. You can see their daily value. You can download a valuation report on that specific company, and you can compare that company to other companies in the index. And what that does is it helps give you a sense of kind of ticker pricing for that company, so that if you were to go to a brokerage platform and see a price, you can be armed with information that says, okay, is that price actually worth it? What does that price look like net of fees, considering SPV of SPV, or even just a high fee single SPV. And that's very powerful in terms of helping people making buying decisions. So happy to offer that, to your users at a discount. If you're an institutional purchaser, and you want like the full kit and caboodle with all 1,300 companies for true valuation purposes, that's a bit pricier, but also happy to discuss.
No, I think that's really powerful, and people should realize that that type of product, if you're thinking about even putting 50, 100, 200K to work in kind of these late stage secondaries, and you're overpaying in a fairly dramatic way because you don't know the price of these things, that could be very, very costly mistake. We have people come to us all the time. Certainly, I've had people come to me and be like, hey, I have this opportunity to buy, Stripe or SpaceX or whatever at X. Do you think that's a good price? And I'm like, I have no idea, right? Because you just don't know. So having that pricing data is so important in making an intelligent decision on whether or not you're overpaying or at least getting what the market is commanding today. So if you were at all thinking about being in this space and making investments on your own, which is okay to do, you certainly can, make sure you're armed with the right data to make smart decisions in this space. So last thing, go ahead, Dave.
I was going to say, I can actually offer an example just in kind of that vein. So Instacart, which many people here know, IPO'd, I believe mid to late last year. They had in our database a closed secondary transaction in December of 2022 for over $134 a share. And they IPO'd in kind of the $30 range about 8 months later. If you had been armed with secondary data, there were bids and asks at the time of that closed trade in the 20 to 40 range, right? So people were already pricing in a lot of this information. If you have the know-how, we're just trying to bring some of that know-how, toward a different type of consumer. So avoiding, mistakes like that, can be really everything in terms of your entry point into private markets.
Absolutely. Well, I'm happy to open this up for any questions that folks have. Feel free to drop it in the Q&A section or into the chat section. I'd be happy to try and get to a few questions before we wrap up here. David, for those who are kind of interested in either checking out your data or learning more about the private index fund that exists today, where should they go? What should they do?
Go to openvc.com and either on the index tab or the fund tab, fill out very basic information form, and we'll get back to you right away.
Terrific. One question that did come through is, they're an unaccredited investor and wondering if they'll be able to invest in a private index fund. Yeah, if you could hit on that.
So that's the dream, right? Today, no, candidly, and for a few reasons. One, kind of not to bring up the DXYZ example again, but we just want to make sure we're getting this right. And that means that we want to launch the fund as a private vehicle, keep it private for about 9 to 12 months, and make sure that it's tracking the index in a really appropriate way before introducing it to the prime time of non-accredited audience. That said, if you're on this call, you may be closer to accredited than you realize. I'd encourage you to kind of check out the requirements, which were changed under the Trump administration to be a little bit more friendly to the average investor. And we do have a platform for small accredited investors to be able to invest in the fund with checks as low as kind of $10,000. So today, no. On the non-accredited, very shortly, yes, is our goal.
Well, I think that's really powerful. If you go to platforms like Forge, right, that obviously have a lot of late stage secondaries available, individual investments, typically the minimum I am seeing, and unfortunately can't partake in, is about 100,000. That's the minimum investment for one investment. So if you could do 10 for 50 of the largest names, obviously creates a far more palatable way of being able to invest and access this market, which I think is great. Let's just talk a little bit more about liquidity of this fund. So dividends, secondary stock sales, and obviously companies IPOing. Are those the three components that will enable liquidity within this fund?
Mhm. So in its private formulation, yes. I would say dividends are super rare in private companies, but technically, yes, that would be an avenue. It would be much more IPOs and sales. When the fund goes public or switches to an interval fund of some kind, then like an interval fund, you'll be able to apply for a quarterly liquidity event and actually cash out your shares of the fund. Or if it's a public BDC, you can sell it on E-Trade, right? That's kind of the ultimate dream. So our goal, kind of thinking of the future, is to have a family of private market indices. Think unicorn index, unicorn AI, unicorn consumer, unicorn real estate. We can get sector specific with it, and a family of funds tracking those indices. All of them ultimately with some avenue for much faster liquidity than your typical venture fund, whether it be interval or listed, will depend on the initial investors in each of those funds, but certainly not on a kind of 5 to 8 year timeline, more on a quarterly basis.
I think it's a fairly large statement that the New York Stock Exchange has backed a company like yours and wants to see something like this exist. I know you can't share all the details, but can you talk a little bit about kind of what interested them in getting into this game and why they think it's important for someone like OpenVC to exist?
Yeah, they're all about expanding opportunity. The NYSE's kind of core mission is that the efficiency of public markets, or as is a core belief, is the efficiency of public markets makes capitalism better. It spreads wealth, right? It enables everybody to compete on a fair and even playing field. And you've seen that with fee compression. You've seen that with the shift toward passive management. You've seen that with the rapid rise in the number of Americans opening brokerage accounts. Like ultimately, people want to engage in long-term wealth creation, and public markets enable that in the fairest possible way. What they see in us is a way to start bridging the gap in private markets where information asymmetry and candidly, it's a little bit of old boy access, have really been safeguards to prevent the average person from being able to participate in those really meaningful wealth appreciations. And so their opportunity is to bring more people into the fold, into the arena. We are a way for them to do that. And so I kind of see it as, their foray into privates.
My gut tells me just, a lot of these companies are staying private. A lot of these companies aren't doing new rounds of funding because they're either profitable or have a lot of money on the balance sheet and don't want to have to do a down round. So you're seeing this pressure on pricing, which is creating these opportunities to buy at 40 to 50% off of the highs. And there's this massive backlog of companies not IPOing right now. At some point, right, the market has to thaw and companies have to start to go public. We've been in kind of this weird period for the last couple of years. I know you can't forecast the future and you don't have a crystal ball, but when you think about when we might start seeing that IPO market heating up again, which is obviously going to create some really interesting insights on how well the fund can perform in the near term. What are your thoughts on when that IPO market does start to heat up for a lot of these late stage secondary companies?
It's the question, right? If I were a betting man, there's two major things. One, it's an election year, and fortunately or unfortunately, folks are much more reticent to deploy capital until they have certainty, and that means that people who are thinking about raising either from the public markets or doing kind of that final pre-IPO growth round are effectively on hold. And then two, rates, right? So the moment that interest rates start to come down, particularly the higher growth tech companies that have had really substantial multiple compression, who are, if you're IPOing in 2021 and you're like an ad tech business, just hypothetically, and you're going to IPO at like a 15 to 20x, just a crazy number. That's not happening today, right? It's just not happening with the rate environment we're in. Now, when rates come down, then multiple expansion comes back into play, right? And so folks are waiting for the Fed to move so that they can go back to the underwriters and really achieve the public market buy-in that they think they deserve, post their kind of massive 21 valuation. So those are the two critical hurdles. One, is happening regardless in November. The other is up to Jerome. I hope he lowers them soon. But we'll see. I think we're probably due for a rate cut pretty shortly.
No, I would tend to agree with you. And every time they even talk about it, right, the markets start reacting. So it'd be interesting to see it if it actually happened.
Right.
Really, really interesting insights. David, thank you so much for your time, your thoughtfulness, for what you're building. I think it's really tremendous. We will follow up with links and a recording of this video so you can all watch it back. And if you signed up and hadn't had the opportunity to be here, we'll be able to watch it back, but we'll make sure to have access to both the data product, especially when it's ready to roll, and access to the accredited platform if you are accredited to be able to invest in the private fund that exists today. Thank you everyone for your time and listening in today. And we hope you have a wonderful day. Take care.